quiet. No, you be quiet. No. No. Yeah. Talking to the dogs. No, they've just gone off. No, that's fine because I'm just counting down. So yeah, no. It's absolutely fine. It was just the dogs. They do go off occasionally when somebody drives past. No, you can hear them. Luna, be quiet. Yes, they've acclimatised very well, actually. Yeah. We had a severe frost the other day, so it was the first time they'd experienced frost, which was quite funny watching them. Yeah. Well, no snow yet, so that'll be the big test. I'm not sure whether they'll think it's a fine or whether they'll think, oh, that's very cold. I don't know. One of them doesn't like getting its paws wet, so it's quite funny, really. No, not very often. But okay, you get you get the occasional sprinkling because it's quite high here. I'm at 500, 600 feet, so it's sort of 150, 200 meters. No, it's not particularly high. But we get the snow more than up on the hills here than down on the path itself. You've had it wetter down there than people expected, I think. Yeah. Just to remind you what it could be like. Yeah, exactly. Well, hi, folks, and welcome. And for those of you listening a little while ago, I think I left the mic open when the dogs went a bit wild, but there you go. Welcome, and good to see so many on in the chat at the moment. Hopefully more will join. We're ready to go and think in a moment or two. The good news is that we have Damien queued up, so you can see him over there. We've got the screens running. We've got the chat running. We've got the multi-view over here, and of course we've got the controlling software over there as well. So everything's running well. And of course the dogs, well, we've got one dog. The other dog's not in her basket at the moment. But Luna was quite interested in the refuse collection, which was going on just a few moments ago. So she made a few barky noises, but there you go. Nevertheless, I think all is good. So interesting conversation, a lot to talk about tonight. Of course, the markets have taken a new turn over the last month. The question is, what does it mean? Does it mean anything? Does it mean nothing? What is some of the other indicators looking like? And good to see so many there in the chat as well. Smooth, Alison, welcome to both, and to all the others there as well. It's great to see you all here, and be a very interesting conversation, I think. Right, I'm going to take the pre-show off. I'm going to run the intro, and I'll be back in a moment. Well, good evening and welcome to this live stream on the 5th of December 2023. Can't believe it's nearly Christmas. It's incredible where this year has gone. I'm Martin North from Digital Finance Analytics. Great to have you on the show tonight, and thanks for spending some of your Tuesday evening with us. It's great to see you. As normal, before I bring my guest in, I'm just going to remind you that we don't provide specific financial or legal advice on the channel. This is a general conversation only. We do moderate the chat, so please play nice in the chat room, but also feel free to throw your comments and questions in. And I won't necessarily follow all of the conversations that are going on, but if you use @WalkTheWorld, you can get my attention or indeed ask a question. This is as at 5th of December 2023 if you're watching in replay. I've also enabled Super Chat, which means that you can get your question to the top of the list, or indeed make a contribution to what we do around here. We don't do this for profit. We do this because we think this is an important conversation to have, and always appreciate the Super Chats. Thank you very much for them. Okay, that's that. Let me bring Damien straight in. Damien, hello. How are you going?
Not too bad, Martin. Yourself?
Yeah, pretty good, pretty good. We've had some interesting winter weather now. So we had a couple of frosts the other day, which were quite severe. And then we've got wet and warm winter weather now. So all over the place, really. But, we're getting used to the cooler climate. I've got my jacket on, got the heating on. So sitting here in the nice warm studio. And, of course, down there in Australia, you had a week of rain and now you're back to nice weather again.
Yeah, it's been fantastic the last couple of days. But, it's 30s and sunny. So, yes, it's been... Summer is back. Well, in Melbourne anyway, for a few weeks or a week or two, and then disappear again, I'm sure.
Well, the weather's bust, isn't it? But look, we got a lot to talk about. I mean, well, the question is are the market busts? I mean, what's happened in the last month is a significant reversal. We had the RBA, of course, out today with its decision, which was to hold rates. No real surprise there. And just on that, it's worth just noting that, she didn't really say much at all. It's the same old. But they still are holding the thought that they might actually need to do more, play close attention, we're resolute in its determination, etc. Nothing really changed. But what's your sense? Do you think the RBA is done, or do you think there's still more to come?
I think the RBA is probably in one of the hardest places relative to other central banks, in that I think there's other central banks are seeing some relatively clear signs of inflation slowing, and they don't have the same issue in terms of self-generated inflation. In terms of, I think a lot of the problems and I've spoken about this several times, on the last previous shows, but we're running this record rates of immigration, and we're struggling with rent increases. So it's it's self-inflicted on that front. We're sort of running quite high energy costs, and we've basically haven't done anything to sort of try and curtail some of the energy cartels sort of sitting in Australia. So again, it's sort of self-inflicted. I think there's So I guess where I'm coming to is that, as I've been speaking about on prior times, is that the RBA is in sort of this unenviable position where we've got the government running this one strategy, and the RBA trying to deal with something quite different. And I do want to jump into a few of Jared Manak's slides from just to sort of run through some of those issues. But I thought I might start just first with just given we're talking about markets, is this was just out the other day. It's a Goldman panic index. Now, they basically bring it together from a few different volatility series and put it what in. And I actually just thought it was a relatively neat encapsulation of where we are for the last month. Is that a month ago it was up at sort of high-ish levels, and that's all eased, and now everyone's content and hasn't been lower in the last year and a half, and it's basically closing in on a zero level for panic. And I think that's probably a good I guess indication of where I've sort of seen markets for the last month in particular, is just that feeling that actually everything is going to be all right. It's all going to it's a nice soft landing in front. There's earnings will eventually pick up, even though there hasn't been too many signs of it so far, and we'll all be fine. Is sort of where it's come from.
And just to be clear, it's the US panic index, right?
That's the US panic index, yes.
So, because I would argue that there are some different dynamics going on in the US relative to some other countries. I think Australia, unfortunately, is, as you said earlier on, a little bit sort of out there relative to some others now, partly because of the homegrown inflation and partly because the interest rates are lower in Australia. But it does seem as though the markets in the US have sort of got really sanguine and saying, we think there'll be a soft landing. The bond yields are reversed. Markets are quite, extended again. And the valuations still look pretty stretched, though, I have to say, in the US
They
markets.
do. So bond yields sort of hit, and this is this part where I just want to talk for a little bit about market structures. So there's a relatively big investment crowd in the US in particular called commodity trading advisors, CTAs. You often hear them as, and there's a lot of quantitative systems that run on momentum-based models. And what that basically means is if something's going up, you buy it, and something's going down, you sell it, in a broad sense. And so, and these guys do change their mind, can change their mind quite quickly. So if you sort of think about there's those ones, then you sort of get into the more fundamental people who are like, okay, I'm trying to outperform or underperform an index, and I'll swing a little bit into bonds or swing into equities, depending upon what's needed. But like they're fully invested. So it's investors like myself, I guess, in terms of people have given me money and have said, I want you to go and invest. And we have equity funds where it's all equities. And so somebody gives me that money and says, yes, I want it to be all equities. And they'll deal with the cash and the bonds themselves. And then there's other funds where we will deal with the cash and the bonds, and so we'll tilt back and forth between them, and so that's how we'll run it. But so these people, so these commodity trading advisors are like in and out and in and out, and now the people like myself are more on a medium time frame. So we're sort of yes, we're drifting in and out. We're watching when markets get expensive, we start tilting one way, and when they get back, and then you get the sort of the final group, which is often characterized as sort of high net worth investors and things like that. And these are people who are like, well, you know what, if the market's on 25 times, I just won't buy it. I'll just stick my money in the bank, or I'll go start some companies, or stick it in private equity, or do something completely different that's not in the stock market or not in the bond market. And then when it gets cheap, I'll sell up these things and throw it back into the stock market, or stick it into property or whatever it is, whatever the other asset classes. And there, I guess, they're people who aren't benchmarked. They're not being told to, you need to outperform an index or something. They're just like, over the long term, we want you to try and you just want to take advantage of opportunities. And if you sort of think about all three of those people sort of getting in and out of markets at various times, I think the the wild swings you see from month to month are usually these commodity trading advisors and the ones that are piling. All of a sudden, everyone's long, and then they've all flipped around, and all of a sudden they're short. And although round numbers are, you like to think we don't sort of fall prey to, something as silly as sort of round numbers and picking those levels. Sometimes it just feels like 5% was this bond yield that was the market was just decided that's where it was going to go, and it pushed it all the way up, and then it hit 5%. And, there was the last, I don't know, 10, 15% of that move to me was largely driven by the machines and the people who are like, this is the momentum. I'm playing the momentum of the yields up to that. And then once it hit 5, they all pretty much switched the very next day, and you saw that all come back out again. Now there certainly was some fundamental news as you spoke about, some inflation easing and things like that. But I do think there is a little bit of market dynamics around the edges here as well, where it's just these guys flipping from one to the other, and you can sort of, in a big picture sense, if you're investing, if you've those second two groups, the sort of the really long-term ones and the sort of the medium-term investors, when they're moving in or out of assets, that will create consistent performance. But if you're trying to chase the commodity trading advisors or whatever, those guys will change their mind, on a dime. So, most sort of fundamental investors will go, well, this is the way I see it. I think this is happening or that's happening, and then you'll gradually change your mind as the facts come out and you start changing it. The traders are more about, if this value hits $5, if the bond yield, until the bond yield hits 5%, I'm buying, and the second it hits 5%, I'm doing a complete flip and I'm going short. And then once it goes down, then I'm going even more short, because now, I've got all these verifications that are sort of flowing through. So yes, so I don't know if that answers your question on what I'm seeing in markets or what.
Yeah, no, it does. And I guess there's a couple of observations. Firstly, you mentioned the machines, and it's hard to get a handle on what proportion of trades are actually just purely machine driven. But my feeling is a lot of it is, and particularly around, as you say, particular benchmarks.
Yep.
And more people seem to be actually running more and more machinery to try and actually just, make a turn and what have you. But the other is value investing. Of course, Charlie Munger, died recently. And of course, the whole question about Warren Buffett and value investing and all of that stuff is a really interesting question. And I wonder what your perspective is of value investing in the context of the machines are running the shop.
Yeah, well, and that's a good example of sort of blind, not quite blindly, but sort of in my parlance, it's sort of there's a little bit of blindness in terms of how you're doing, in terms of how it's investing. So I've got a chart I want to throw up, which is showing the last 15 years of value, which is the blue line, and the world index. So this is world value index, MSCI, which is pretty much thought of as the benchmark for value investing. And then this, and then the MSCI world. This is a total return index. If you look at the actual price index, it's underperformed even way more because they usually pay quite high dividends. So this sort of keeps that in track. But basically, over the last decade, you've done about 50% worse in value investing. Now, I do think there are some strategies, and value actually is one of them, but we'll get to that in a while, where you do have to be patient and you do have to sort of rely on the fact that there's things will go against you, and then eventually things come back. 10 years is starting to stretch the friendship, and 50% is a pretty big margin to you got to do a lot of performance to make up a 50% underperformance in terms of that. And so what I wanted to sort of briefly touch on, and sort of with an eye out to Warren Buffett and to Charlie Munger, is that this is a very mechanical index that's been put together, and value investors themselves usually have what I'd call another axis. So and so whenever you jump into hearing Charlie Munger talk or you listen to Warren Buffett, what they're saying is they're always talking about this idea of margin of safety. They're talking about intrinsic valuation and about buying the stocks at a discount to that. Now, that's not value investing. What that is that's buying quality stocks, stocks with a certain level of quality at a valuation that's attractive. So you're taking advantage. You have an eye to valuation, but you're not out there just saying I'm just going to buy the cheapest thing possible. And the way I'd think about, I often ask people to think about this is if you think about cars and buying a car, is you are not going to buy the cheapest car available. Because if you buy the cheapest car available, it probably doesn't even run. Spend $500 on a car, it probably doesn't go. Yes, you own a car technically, but it's actually of no practical use. Add another $5,000 to that, and actually now you've got something that probably goes a fair bit of the time, and might not be as flash as other ones, but it's probably workable. Add another $5,000, and you get this big jump again in terms of quality and what the car does, and reliability and things like that. But then as you keep on going further and further up, the jumps start getting bigger and bigger. Like if you need to go from a 3 Series BMW to a 7 Series BMW, arguably the actual utility you get out of that in terms of getting you from A to B and comfort and things like that is pretty small. But you're talking about a $50,000 jump in price. And so it's this idea about how am I trading off value versus what I'm actually getting for it. And so that's where I think, when it comes back to investing is, that's very much what Warren Buffett and Charlie Munger would very much sort of push, is that you need to be getting something for your value. It's not just a matter about blindly buying the cheapest. And these value indexes basically blindly buy the cheapest stuff. There's been some pretty big changes in terms of the accounting standards over the last 20 or 30 years. The value indexes haven't kept up. It's a very sort of naive type of value, or superficial value, as I like to call it. If you look at something like actually, I might show this other one just to simplify. If I break value into what are the components of value that's actually working and which ones aren't, and this is sort of looking back 10 years, and the red bits are bad years for value, and the green bits are good years. And it's breaking it up and saying, well, what happens if I bought at the bottom is dividend yield. So if I bought something just on dividend yield, you have these fantastic years. Last year you're up 66%. This year you're down 33%, and over 2020 you're down 33% as well. And so it's just this wild ride about whether you're making bucket loads of money or not making much money, and net over the last sort of 10 years, buying something because it had a high dividend yield is one of the worst things you could have done in terms of performance. And then if you compare that to there's even worse than that though, is buying something on a book to price. That's the second one. That's sort of down almost 5% over the last 10 years and 7% over the last 5. And that's basically just saying, what's the book value of this thing, compare that to the market price and just buy the cheapest ones. The one that has worked really well, or relative to all the rest of them, is this FCF to prices. It's a top one. It's the free cash flow. And that's where, I guess where we're saying is that you actually do need to dig into these figures where the way they sort of mechanically put this index together, book to prices, is heavy weighting, and they don't use free cash flow to price at all. They don't look at cash flows. They don't look at some of the different forecast earnings and the variations you can get on it aren't looked at in a way that any sort of fundamental value investor would look at it. And so I guess where I'm coming to with this is there is a benefit to investors about taking certain tilts at particular times, and value is a tilt that I think should be definitely taken at particular times. But if you just rely on an ETF, an ETF of a value, MSCI value, you might be getting something very different to what a value analyst would actually say you're going to pick up. And I guess just to sort of close off on that. When do you want to buy value? Well, the thing with value stocks is they're cheap for a reason, usually. Stocks are usually cheap for a reason. And typically it's because value stocks tend to be the stocks that don't have a lot of pricing power. So they're, cement manufacturers and car manufacturers and things like that, where, if you try and double your price, well, you're just going to lose all your market share because everyone's going to go to your competitors, regardless of how much they might like you. Your product is just not that different to your competitors. And so typically when you want to buy them is when we're in this growth catch-up phase and inflation's rising and it's sort of the end of the cycle and sort of you're at the start of an inventory cycle. There's more fiscal expenditure out there, and companies can actually finally put through price rises they haven't been able to put through at any other time in the cycle because there's all this demand and everything's growing. And that pretty much describes the environment from, maybe not this year, but, the year before and that whole, inflationary push. That was a time to be owning value stocks. When you don't want to own them is when growth is starting to slow, when inflation's moderating, you're reaching the end of this inventory cycle and you're getting less fiscal expenditure. That's the time when you see the earnings of these companies. They're the ones that the transport companies where they managed to go from charging $1,500 for a container up to $10,000, and then it crashed back down to $1,500 again. Or the car manufacturers who managed to stick these massive great price increases because nobody could produce cars because they couldn't get the chips. But now they're all starting to flood in, and price wars in China and all these things are starting to break out. So it's It's the thing about saying value is a great tool to have. You want to keep an eye on it, but the sort of the traditional value stocks, the more industrial, more commodity end of the market, you probably not for this time of the cycle, unless you have a completely different view of the cycle than me. Where I think we're still in this inflation moderating, growth slowing, end of inventory cycle, less fiscal expenditure. It's time to look for quality. Is my take for where we should be looking at now.
So just to be clear, many people would say value investing is about looking for mispriced opportunities, right? So in other words, they appear cheap, but there's a reason why they're cheap, but there's also an expectation that they might actually accelerate in value relative to the market.
Yeah.
Now, in recent times, that has not worked that well for most people in that sector of the market.
No, that's right. But if you looked at particular sectors, if you grab particular sectors and looked at stocks within it and went, okay, if I'm trying to find stocks that have got good cash flows, the forecast earnings are a bit better, and you got some momentum behind the forecast earnings, and you can look at the values based on a number of different factors like that, then value actually was working. It's this pure, I just look at the book value and I buy the cheapest on the book value, or I look at the dividend yield and I buy the highest dividend yield. That type of value has been terrible over the last 10 years. And some of that's accounting standard changes. And actually, sorry, the other thing I should note with value as well is there's all these different quantitative methods out there about how do you find stocks that are going to outperform. And I spoke about momentum, which are the commodity traders advisors, where you're buying what's going up. Some of the other common ones are quality, in terms of I'm buying stocks with big margins and wide moats and all that type of stuff like that. There's quality value. There's growth. So I'm trying to find stocks that are growing strongly. There's low volatility. I'm trying to buy those. What's interesting about all these strategies is all of them are what you'd call you're expecting persistence. You're not expecting a mean reversion. So what I mean by that is, if I'm buying momentum stock because it's going up, I'm expecting it to keep going up. If I'm buying a high quality stock because I think it's got wide moats and all that type of things, I think it's going to still be a high quality stock tomorrow. Same with a growth stock. I'm buying a growth stock because it's growing today and I think it's going to keep growing tomorrow. So I'm not betting on mean reversion. And so what you find with those strategies is they're not as volatile and you do get more steady returns. In value, when you're trying to buy value, what you're really betting on is a mean reversion. You're saying, I'm buying this stock that's cheap now with the expectation it's not going to be cheap tomorrow, or it's going to at least increase to be sort of an average value. And so you're taking a very different bet. And because of that bet, that's why in value, traditionally, what tends to happen is value stocks will underperform for a number of years, and then they'll make it all back suddenly in 1 or 2 years. And I liken it to a religion. Is you actually get the if you read any of the value newsletters and stuff like that, it's preached like a religion. It says, yes, things have been bad, but trust me, everything's going to come good. And I'm the prophet, I'm going to interpret Ben Graham's words or Warren Buffett's word for you. And I'm the prophet. And for just, $9.99 a year, you can subscribe to my newsletter and I'll give you I'll give you the word from on high. And the thing with value is, because it only performs every now and again, you can you can explain away if you're in that. Yeah, you sort of don't know as much as well. Is this manager a good manager, or is it just that they're and then when that value tide suddenly comes in, they're going to do great, or because you only find out once every sort of 5 years or 10 years, and so you can go through these long periods. So yeah, it's a fascinating sector, but I guess the thing that the real lessons of what I want people to know is you need another axis. You need to be buying stocks that are good value with certain growth characteristics, or they're good value with good margins, or don't just buy the cheapest out there.
No, it is very interesting, and in fact, there was a little question that popped in, which I'm going to put it up on the screen now, from Cameron Smith, saying, "Is CBA good value at 104?" Now it's interesting, right? So if you look at CBA, which I can put on the screen now, you can see that it's been knocking around 104 since 2021, right? But it's sort of going pretty much sideways. And going back to what you said, Damien, about you got to think about where you are in the cycle. Now, you'd argue, I think, that the financial sector is probably at an interesting inflection point in the cycle at the moment. So it does beg the interesting question as to whether, the CBA type stocks are actually value stocks at all at the moment.
Yeah. So CBA is one of the more expensive banks in the world, with one of the highest returns in terms of it's one of the highest quality ones as well. And so, so if you look globally, there's not many banks you find more expensive than CBA. So what does that mean? And this is a part, I think I've postulated this a few times on your shows. So I generally want to know why things are happening. Like I like to dig into just the simple. So why does CBA? Why are they so profitable? And actually, most of the Australian banks are very profitable relative to the international peers. And then you get into that whole part about, well, actually, a lot of the funding, they got all this cheap funding from governments, and they get, they've implicit government guarantees, and there's all this thing. They're government backed effectively, and so in a way, and particularly if you look at, say, the European banks, they were given like negative interest rates in order to keep them profitable and to keep them from falling over the last few years. Is that arguably it's a case of how close are you to your regulators? If you're really close, like an Australian bank, and they let you earn supercharged profits, then you'll make these great returns and you'll look like a very high quality bank. If you're in Europe, where they're a bit more circumspect about and saying, well, yeah, we'll let you keep it, we'll keep you alive, but we're not going to let you make, dramatically high profits, then you end up with a different profile. And then you look at somewhere like the US, where there's 10,000 banks or something like that, and lots more competition, and maybe not as much. There is still a fair bit of concentration at the top end, but yeah, it's a lot less because there's so many more banks. It's harder to be as close to your regulators. And so the question really is, if you think Aussie banks are going to stay close to the regulators, and the regulators aren't going to be too harsh on what they're cracking down on, and you don't get ACCC looking at them and things like that, and you have banking royal commissions that come out with these massive lists of things to do and then somehow disappear without most of them getting done, then the Aussie banks are probably going to keep performing. The big issue for Aussie banks obviously is the lending side. And that's with any bank, though, at the moment, is saying, how bad is this? So actually, I should take one step back. So as a big picture, long term, Aussie banks, high quality but expensive, as long as you think they're going to keep, and CBA, the highest quality and the most expensive of those, but probably all right if in the long term, if you think they're going to maintain that strong relationship with governments and be allowed to make these supercharged profits you don't see elsewhere. If you think that's reversing, then it's a sort of a longer term sell. In the short term, what you need to be worried about is how is this going to be a soft landing? If it's going to be a soft landing, then the banks are probably going to look decent value. If it's going to be a hard landing, then they look way too expensive. And then the question is, where do we sit in between? So, yeah. That's for, I'm more leaning on I think it'll be I think there'll be certain elements of it that'll be hard. And so, so I'm less keen to own banks at these levels. But it comes down to your macroeconomic outlook. Oh, sorry. And one last thing I do want to say as well is that it's on banks and resources. So banks are sort of 40 odd % of the Aussie market. And then you add in resources and you get up to sort of 60 something % of the market. So when you buy the ASX, you are effectively buying 60% banks and resources. If I was a financial planner in the US and you showed up, or the UK, or pretty much anywhere except Australia, and you turned up and said, I'd like a market-based portfolio, and I went and put you into 60% banks and resources, I'd probably get fired if anything went wrong. You'd be suing me. Whereas in Australia, that's the market. In we go. So yeah, it's a very
and it's interesting because a few analysts I've been reading and the recent times have said now is the time for stock picking. In other words, you've got to actually do the work. You've actually got to pull these markets apart and look at individual players rather than just riding indices and things. What's your take on that? Do you think that's a good piece of advice, or can you basically hug the index?
I think the market goes through phases where when large caps outperform, then whether you're in the index or not doesn't make as much difference. Because the large cap, effectively when you buy the index, you're getting lots and lots of large caps because they make up the biggest part of the index. So it does vary. I think for me, I like to think you can get a better risk return trade-off by tilting between value and growth. That's what we tend to do within our portfolios, with our active portfolios. But we do have lots of passive portfolios as well. So, with a view that low fees, if you can keep your fees really low and stick it in there and forget about it and come back in 20 years' time, then you're probably going to be all right. I do think on that risk return basis, you can get better, you can have lower volatility over that time frame, and you can get better returns from being a more active investor. But keeping your fees really low is very important. If you're going to be paying 2 and 20 or 2%, that's 2% of your balance and a 20% on the outperformance, which is a common hedge fund one, it's going to be very hard to outperform. So keeping your fees low is very important, and then it's a matter of trying to work out. In terms of being a stock picker's market, it's always a stock picker's market. That's always people are always saying that. But I do think they're probably a little bit more right than they usually are at the moment, because I do think we've been through this phase where everyone got to shove through price rises, and that I think what we're going to find is over the next 6 to 12 months, we're going to see which companies really genuinely have that pricing power and can hold on to those price rises, and which ones just have to give it all back. And that's going to be, I think, your key investment phase over the next sort of 6 to 12 months, is trying to find the companies that don't have to.
Yeah, and it is worth reflecting on this point, Damien. If you were to look at the equal weight, I'm looking at the US equal weight index at the moment. It's a fascinating story because, of course, the story overall is the indices are actually quite close to highs, right? But the equal weight story is, and this is actually the Goldman Sachs equal weight large cap US one, has gone nowhere.
Over what period?
This is actually from April through to November.
Right. Okay.
If I go through a longer period, so we can go, if I look at it over, let me think, one day, that might give us so that's now from 2018 through to 2020. So you can see that actually equal weight was higher in 2022 than it is now, which is quite interesting. So it tells you something quite important about the mix of stocks within the index and how they actually are performing quite differently. And of course, the Magnificent Seven in the US have been driving a lot of the performance. But it shows you that some indices behave differently to others. Surprise, surprise.
Yeah, absolutely. It's been, and then that's, I think last time I was here, we spoke about how in the third quarter earnings, I can't remember exactly the figures, but I think basically you would have it would have definitely been negative if you hadn't have had those 7 stocks in there making all your returns, and then all the other stocks are giving back whatever they made plus more. So, yep, definitely going through those periods.
Which it makes the point that you've got to understand quite a lot of the dynamics here to actually make good decisions rather than bad decisions. Because I guess the problem at the moment is we're seeing quite a lot of market sentiment turning, and then the electronic trades drive that and reinforce the volatility. So what's your sense in terms of volatility ahead? You think we're going to continue with these volatile movements, or do you think it's a fundamental move?
Well, I don't think this rise is a fundamental one. It's certainly not driven by earnings increasing. So, yeah. and we are looking at quite high valuations now. So earnings are still pretty much flat in terms of what's expected. The issue we've seen is that there's some really big numbers forecast in terms of what's coming over the next year. So put it in perspective, 2023 will come in at a slight negative in terms of the earnings. It's expected that 2024 is currently priced in at 2024 and 2025 together is about 25% growth in terms of earnings, which are pretty cracking years. We don't have that many years where earnings growth is up, double digits 2 years in a row. So a boom has been forecast. Now, when I actually look at the companies and listening to the company, what they're forecasting, what they're saying, is that I get this distinct impression that companies are effectively saying, look, things have been pretty tough for the last 9 months or a year. Margins have been falling, profits are down. We think it's starting to turn around. We think the costs are we're starting to see less cost pressures. We think we'll be able to push through price rises next year still, because we did this year, and all these costs are going to come off. And so actually it might be all right by the end of the year. And on an individual basis, that sort of sounds vaguely reasonable. But that can't happen to everyone. Like everyone's, as a company, if I think that my costs are easing, well, all my costs are somebody else's revenues. And so if everyone's sort of coming up with this same story, effectively what they're saying is, gee, companies are going to do it really tough next year. They're all going to have to put their prices down. Oh, except me. I'll be fine. I'll be able to put my prices up. He's saying, well, some of them will be right, but the vast majority is going to be wrong if that's the case. And that's where I think where we're going to see the further earnings weakness coming over the next, over the next sort of 12 months, because, even if you're in the soft landing camp, it still implies that there's some sort of there's some sort of continual down, and then you reach a bottom, and it's not talking about over the next 12 months some rapid increase in profitability, which is what is sort of priced into analyst numbers at the moment.
Yeah, and it's worth saying that a lot of the analysts, when they start their forecast for next year, start at a high number, because that's what they did. So they're extrapolating effectively from what's happened previously, and then they sort of flex it, and then as things go on, they then get more realistic about it. And what's surprising in that is if you look at the numbers and you go, okay, somebody's forecasting 10% this year and 10% next year, say, for example. So they're saying they earned 100, next year it's going to be 110, the year after it's going to be 121. And then they talk to the company, and the company's like, I'm not going to earn 110, it's only going to be 107. And so what they do is they go, okay, I'm going to take my next year's earnings and I'm going to mark it down from 110 to 107. And the year after, maybe they'll recover a bit. So I'll go from 121 to 119, for example. Taking the first year down by 3 and the second year down by 2. And it all sounds relatively reasonable. But actually what you've done is you've actually increased your growth rate for the second year. And so what tends to happen is you can actually see this in the numbers. As analysts downgrade that first year, they increase the sales forecast to the second year. And then they wait 3 or 4 months, and then they realize, oh, actually, now I'm down to, now I'm suddenly forecasting a 15% growth for that. That's not right. And then you see a shove down in those numbers as well. So yeah, it's a very behavioral science way of looking at it. Sorry for cutting you off. No. You made the point I was wanting you to make, so that was perfect. And the fact is that these things move around, and analysts, of course, do change their views sometimes, but they tend to start very bullish and then come back. So in a way, you can't necessarily take as gospel what their first stake in the ground is in terms of future earnings, because almost always they overestimate.
Yep. And then The last one will be an underestimate. That's the other one I'd say to people: don't look at beats, because that's the one where, the analyst, the company says, okay, we're going to do 110 next year, and analysts will put 110 or 111 or 109, whatever the thing is, and then they do what I said is they come out and they say, oh no, it's only going to be 107, and then analysts will downgrade, and then they get a month or two out and they're like, actually, you know what, it's going to be even worse than that. It's probably only 106, and so then analysts all come in and put in 106. And then the day the company comes out and they go, oh, we earned 107. And everyone goes, oh, they beat their earnings. And you're like, no, they didn't. It was exactly the same earnings they had 3 months ago. They just lowered the bar first and then hopped over the lower bar and congratulated themselves. So, and it's, 30% down on what it was, 6 months earlier. So yes, there's lots of games with analyst numbers.
Absolutely. Now here's a quick question for you from Down Under Drover. What ASX ETF does Nucleus Wealth have, looking to try some different ETFs?
Oh, okay. Yeah. So what we do is actually different. We have what's called direct indexing. So we buy all the individual stocks within the portfolio. So if you want to go the passive side, so it's depends on what platform you go through, but it starts at sort of 17 basis points, so 0.17%, and you choose how many stocks you want in it. Do I want 25? Do I want 40? Do I want 75 stocks in it? And then you get to add and subtract. You can then say, okay, I don't want any carbon stuff in there, or I don't want, I want nuclear power. I don't want nuclear power. And so, So we basically have, you start with your base index, and then you add things in and take it out around the edges, and you can sort of do that to a bigger or less degree. And then you own all the individual stocks and the tilts within your portfolios. So thanks for the shameless plug, or the invitation to give a shameless plug.
No, that's good. And I think that's a really important observation, right? Because, it's a different philosophy to the way that a lot of the ETFs that are out there are functioning at the moment.
Yeah, absolutely. I mean, I always use it in talking about this. It's the ETF industry is a bit like the your Henry Ford from the 1920s. You can have any color you want as long as it's black.
Yep.
You get what they have. Whereas, or if you want to, you can go, here's the stockbroker, you can go and buy all the stuff yourself. Here's all the parts, you put it all together. And you're like, well, no, I just wanted the working car, but I just wanted to make a few modifications. Like, whatever reason, I have a relative who died of lung cancer. I never want to have any tobacco stocks in my index. So, okay, great. Rather than whatever, we'll give you that index and you can cut out those. And actually, I'd love to have an extra exposure to cybersecurity stocks, or I'd love to have an extra exposure to the big seven, and then sort of add in a tilt with that.
Absolutely. Now let's move the conversation forward, because you mentioned Jared Minnick and his recent work. And I think this was a very powerful piece of analysis that he did. Long-standing analyst and very significant observer of the Australian situation. And there were some very important messages that he actually was able to highlight in some of his recent publications. Yeah,
some great charts. And I love the, I feel like I've probably expressed it this way, but not as succinctly and as well as what he did, in terms of saying, well, effectively what Australia decided to do from 2012 onwards is, rather than they've done a giant sort of capital to labor switch. So most advanced economies, when they want to grow faster, they go and invest. You say, okay, we want to grow faster. Let's go and actually do more investment, get better machines or whatever it is, and use that to sort of get another leg up of growth. What Australia did instead was flood the market with more people. And you can see very distinctly on this chart, we've got the real household disposable income per capita. Now, I do think this is slightly overstated, and it started in 2000, which is was a good year, and it's a good time to start in terms of the end of the tech boom and stuff like that, and the rise of China. So it's probably that first line is the trend's a bit steep. But you can just see there's a very distinct break come that 2012, where we decided, no, actually, we're going to pour as many possible people as we can into here and run it that way instead. And so, so GDP has been pretty good in terms of, because GDP is the number of people times the GDP per capita, and we're growing the number of people so quickly that GDP growth looks pretty good. But when you look at per capita, all of a sudden it looks bad. And, I don't know about you, Martin, but I care a lot about I care more about the individuals than I do about the overall I think if you've got individuals coming through and they're all doing it tough, but overall, because you've just got more individuals, it's not a sign for a happy population.
And just on that, it's just worth re-emphasizing. GDP per capita has been going backwards for some little time, but most of the top line reporting is the gross GDP, which is the top line number. And of course, as you bring more people in the country, the top line GDP number just goes higher and higher and higher. So at a superficial level, the government can say, see, everything's fine. But on an individual basis, your share of the wealth is actually diminishing. And that's why real incomes are going backwards, and why if you look at the total returns that the people have, they're actually lower than they were a decade ago.
Yes. So I've got, sorry, I've slipped off that one. So some of these other charts I thought were good. So house price to GDP per capita. So again, that's just relating it back to, we've obviously had 100 years of pretty steady at one level and jumping. But the starker one that we were, Martin, you and I were just talking about beforehand was this chart about Japan. Now, for any of the younger listeners, Japan had like a monster property boom in the 1990s. It was at one stage, the land under the Emperor's Palace in Tokyo was worth more than the entire state of California. It was just, it was crazy. And you can see that it sort of reached 330% of GDP as the value of land, and then it's crashed over the next sort of 20 years. We're there. We made it. We're at similar levels. I think there is a little bit here in that Japan's a smaller country, a lot more people, and so the land relative to households or whatever. But the overall thing is still the same. Is that we are bit up. We're doing this to ourselves. We're doing this to ourselves, and it doesn't. When you're basically saying to businesses that we're going to embed this massive cost into the cost of land and charge that to everyone. Is it makes everyone that little bit poorer, except for the original landowners. And so, And
I guess the other message, Damien, is land values can come down.
No.
Well, it didn't in Japan.
Martin. They're different over there, Martin. We like to live in our houses over here.
Yeah. So, I mean, it is an interesting observation. And when you're actually buying a property in Australia, the land value is a significant proportion of the value. If you did the calculations of what it takes to build a place on a plot, then by definition, the plot itself is actually a significant element. Less so, of course, in high-rise land, but of course they solve that by building ever higher, which means you get more units to get the return. But the question is this a sustainable path, or is it ultimately going to wobble a bit like like Japan did? But this is the other one you've just put out. This is a real killer chart, right? The effective impact of this means that people have to borrow a hell of a lot more to get into the market, and as a result, less people are actually owning outright. More people have a mortgage into older age, and all of those things.
Yeah. So in 1995, 10% of 25 to 34-year-olds had a house without a mortgage. Now it's whatever, almost nothing. 55 to 64-year-olds. So people are just about to retire. In 1995, 75% of them had, a house without a mortgage. Now we're back under 40. And so what does that mean? That means everyone has to work longer. And so then they've got, you sort of strip that back to this chart. Now, this one was a little bit confusing. Not confusing. It's a little bit complex, but it's just as powerful in terms of saying, if you had have taken the, so we've got an aging population. So you should expect that over time, fewer people should be working because everyone's getting that little bit older. And so we should have more people over the age of 65, as a percentage of the population. So the actual participation rate, if we just held age and gender participation rates constant at 2008 to 2010 levels, what we should have seen was 65% of us working in 2010, and by now it should be down to 62% because we've just had more older people, and more and we've had to send more women back to work, and so what that's meant is that we're inflicting a certain type of slave labor on people to say, well, we're celebrating that we've got 67% of people working at the moment, but actually a lot of those people are people who 10 years ago, even 15 years ago, would have been retired by now, or would have been able to have work less at home and not have to go to work. They would have been able to spend more time minding kids or doing something like that they actually wanted to do, rather than actually being forced to work to try and pay off these high house prices that we've given ourselves. So there's that one. I think there's one. Yeah, and that sort of led into this whole idea of capital stock as well, was that there's a certain amount of capital. So if you come to Australia, so we live in Australia, there's a certain amount of roads that have been built, of hospitals, of bridges, of ports, and all these things that are available. Each person living here has got a certain proportion of that. And every year those ports and roads and everything like that depreciate, and we have to build new ones just to replace. We have to spend a certain amount of money just to replace existing capital structure. And also, like, there's factories and all these other things that go into this capital. Because we're bringing in so many people now, we need to be spending sort of 7.5% of capital just to stay still. So just because of all the people, just to keep, because we're basically spreading a smaller amount. We need to build more capital for the people that are coming in. Plus, we've then got to go and keep all the old capital up to date as well. And so we're sort of at this different level, which means the capital stock per person is going backwards, and our GDP per hour worked is going backwards as well. And then when you compare that to what's happening in CapEx, I've got the mining chart up just to sort of show that's a bit different. But the non-mining CapEx has just been falling for the last 15, 20 years. And so, so we're sort of stuck in this part where, I guess that's my biggest complaint with the amount of immigration that's going on is not that there's a certain amount of immigration going on. It's that we haven't built for it. If we said this is what we're going to do, we're going to run it at 500,000 people per year, and we've got all this building going on so that we're not going to have house shortages, and we're not going to have rental shortages and things like that. And we're going to be pre-building new towns and cities and schools and hospitals and all this type of stuff like that. Then fine, go for it. I have no problems at all with it. But the problem we've got is, as you can see from this chart, we've been running down the capital. We're not spending the money, but we're pouring the people in and just sort of spreading everything a little bit thinner, and then running into that problem that we've got fewer, we've got negative earnings or negative GDP, negative income for people on a GDP basis.
And just add on things like that: investment in health services, education services, transport, all the other basic things that you need to be able to actually get around is going backwards. And of course, the government's announced that they're reviewing some of their capital expenditure programs because effectively they think they're spending too much.
Yes. Well, that was the one I wanted to show you here. This is the one good chart. Yes. Now this is electricity, gas, water, and waste. So we have a boom in terms of that. Now some of this is climate change. So some of this renewable energy. Like, there is a big spend on renewable energy, and I've been on the show plenty of times, talked about your renewable energy. I like it. It's great. I think there's benefits for it. I think there's, we'll reach a cap of prices. Go watch some of the other shows for positives. On a purely economic basis, we had energy before. We will have energy again on the other side. We haven't really added a lot of productivity to it. So even the capex that we are actually spending on, and I definitely don't want to. I want to say that, this is good capex if we want to get to net zero and all that type of stuff like that, but it's actually not adding anything to anyone. Like, we're actually detracting from, by spending that money. It's the equivalent of saying we had a working power plant, but it was spewing out all this carbon dioxide. So we're going to replace it with solar panels and wind power and all that type of stuff like that, and close this working power plant down, or not build a new one. And so, it hasn't added to our capacity. We've had to do all this furious building to match our old capacity. So, yeah. So, yes.
Absolutely. It just shows you the complexity of trying to manage all of this. And I guess it comes back to the point that, the 500,000 or thereabouts of people coming into the country is definitely creating an issue. And of course, it's rental as well. Interesting, in the UK, where they had more than 740,000 over the last 12 months, they've just announced initiatives to try and turn the tap back. They're doing things like, for example, not allowing people to be paid less than the wage in the country for the same job, which is an interesting move.
Yeah. And skilled, even talking about the skilled ones in Australia, where like the average wage of the skilled workers coming over is less than the average wage. You're like, well, how come they're skilled if they're getting paid less than the average wage?
Correct. So that's and the other one they've announced is that they can't bring, rabbits and relations and the whole family. So they're trying to sort of. Now this is a very interesting and politically charged discussion, obviously, for reasons. But then the health sector says, well, hang on a moment, we are totally reliant on cheap, medically trained people to come in to keep our health service going. So if you turn that off, then the health service and particularly the caring services just will completely fall over. So we've created a monster. It's true in Australia too.
Well, absolutely, but it's that problem, isn't it? You're saying, "Oh, but I need you." The funniest one is when you hear the guys that you hear the Americans and the building guys say, "Oh, we need to bring in more people to build because we need to build more houses for the people who we're bringing in." And you're like,
"Yeah,
sorry,
feedback."
Exactly.
Exactly right. Bring in builders to build houses for the people who are coming into the country. Now, there's another interesting conversation I want to have with you, Damien, because there's a thing called excess deaths. And excess deaths is actually something that I think people are beginning to wake up to as a significant issue. Now, you've done some work on this. It's worth, I think, just chatting about this for a bit.
Yeah, so we spoke last time about the obesity drugs that have come out and the benefits that they make. And sort of part of this, so one of the key areas that sort of that falls into is how it affects some of the insurers. And what I really noticed in this last reporting season was the life insurers and the reinsurers who specialize in life as well. They've sort of basically gone from, okay, we've had all these excess deaths, there's going to be a payback, and we're going to get this benefit on the other side of it, to like, no, this thing's locked in. It's not changing for the next till 2030 or beyond. And what do we mean by this? So if we look, I've got a whole bunch of different countries up here. You can see Australia. This is showing their excess deaths. So the amount of people that have died more than what we would have expected based on the age and things like that. And so Australia's been running at 20% for the last year or so. It's come down a little bit recently, but certainly very high. And then you just look through every other country and you just see that same trend over and over again. Some big spikes for COVID. And actually, I've actually positioned these charts to take out the worst deaths from COVID, so that just so the chart shows a bit better. The actual deaths, if you put in the actual COVID deaths, that spiked a lot higher in the prior year, but they're running at much higher rates. And why this is a concern, and what insurers were basically pricing in, was this idea that excess deaths sort of move along this line where you've got that trend line running between it, and you have a few more deaths in one year and then a few less in the next year, and you sort of bounce back and forth. And the way people were thinking about COVID, and insurers in particular, was that, okay, a lot of people died, but a lot of the people who died were actually very sick already. And so a lot of them were people who may well have died in the next couple of years, in that year or the next few years already. So to put some sort of just random numbers around it, say you had 100,000 excess deaths because of COVID. The thought was, well, okay, that's 100,000 people that have died. Maybe what that means is actually we'll have 20,000 less deaths next year and the year after and the year after that, because the people that were going to die in that have already died this year. And so that's the way insurance companies were sort of looking at it and trying to price it in. So that's no longer the case. They're now saying we've had a significant change in trend, and this is, while the excess deaths is falling away in certain extents, it looks like it's going on for a longer period of time. And so the big question is, where is it coming from? Now, there's lots of different debate about it. I'll give you my take on where I can see this coming from is that there's sort of five main areas that you sort of draw back to. One is continued COVID deaths. So there are still people dying from COVID, nowhere near as many as before, but certainly that's there. It's a new addition to it. We've got this sort of lack of diagnosis deaths that is hitting us. Well, that has been hitting us for a few years, but sort of coming out as well. So people that would have gone in for a checkup, didn't go in for a checkup, so they didn't catch whatever disease it was for another year or two, and then ended up dying, or more likely to die, end up being in a much worse situation than if they had caught it earlier. Suicides, drug overdoses is still high. Maybe there's this idea of the weakening of immune systems as well. And then the last one is maybe the vaccines. Now, I will highlight straight up, there's lots of data you can find on the internet that shows you that vaccines very clearly is causing it all. Most of that's wrong. Most of the data that is it's cherry picked and it's about showing, here's a group of people that were unvaccinated and a group of people that were vaccinated. And look, there's a bunch of people that is vaccinated dying, but ignoring the fact that actually the age range in the vaccinated ones was like 20 years older than the other one. And so when you do in the studies I've seen that do the proper age for age type ones, it doesn't show like it's coming up for vaccines. You can't rule it out. Maybe that will pop up as a bigger issue later on. But for the moment, I think that one's isn't right yet. But if you look at, heart disease, cancer, they're all spiked much higher than usual, and they're running way above average. What I wanted to do is just sort of show what do people die of, and this is more generally using US. And so it's what it's showing here is heart disease is one of the biggest killers, and very seasonal. Cancer as well, and then you get all these other ones at the bottom: accidents, suicides, respiratory diseases, things like that. They're all much lower than the rates you have for heart disease and cancer, which is sort of your real big killers. The interesting thing when you break it down by age is that, and this another thing that points to it probably not being the vaccines, is that actually ages 0 to 14, there's actually far fewer people. They've had, you don't have excess deaths in 0 to 14. And for the ages 15 to 64, the excess deaths have mostly gone away for those people as well. Where the excess deaths really are still is that 60 to 75 group. And then depending upon which country you go to, 75 to 84 and is particularly high. The 85 plus is actually pretty close to back to normal in many countries. And so so then it sort of comes back to that. Well, is this a temporary measure? And I've got a few other charts that show it's pretty much the same whether you look at Germany, you look at Australia, pick your country. It's very similar within many countries. What I was going to say was, you do have that lack of diagnosis. Is it really sort of stuck a hole in it? And so if that's the case, then you would expect that over the next few years that will go back to normal. There is this thing about weakened immune systems. So because you've had COVID now, when you did get heart disease, it killed you, or when you did get the next thing, it killed you. And so that's a potential that, maybe that's permanently decreased people's lifespans and might stay there for forever. And then you get, I've got a few charts on vaccines. Actually, I've got a bunch of different charts here. I probably shouldn't run through them all because it's all I guess that the net effect of all of them was really showing for me is that there's a profound trend. To me, it seems as if most of the reasons for it have got a longer term reversion to the mean in terms of saying, okay, if a certain amount of people have died because of more people have been weakened, their system's been weakened, and so more people are dying earlier than what's the case, is that at some stage you do get the next cohort of people coming through who are back to more normal levels. So I spoke about those younger cohorts that are back to more normal levels. And so you do get this payback where it's the sicker people have died, but they're still going to continue to die for a few years, but eventually you do get a bit of a payback on that. And so I guess where I'm getting to with all this is I think within these trends, it actually looks, and especially in the way we're hearing life insurers talk about this, is that they're concerned enough to now change all their tables. I feel as if they've priced that in now, and they've actually made that assumption that this is where we're going and the new world we're going to live. If they're wrong, and if we do see a reversion back and a catch up, is there's sort of a benefit within that. And I do so I guess where I'm getting to with that is I think there is an overall I think this excess death is concerning. We should be paying more attention to it. But if there is a reversion to mean, then life insurers and health insurers, these same ones that we're talking to you about saying you should be buying these things for the obesity drug benefit and the extra lives that the obesity drug, having this obesity drug is going to save over the coming years, is that you'll get a little bit of an extra pickup as well from this. And then also we think some of the driverless cars, which is, over the next sort of 10 years is coming out as well, is that's going to help as well in terms of the health front. So you get advances in medicine. We've got all these new RNA drugs out there. We've got some more stuff on tailoring sort of gene therapies. We've got this obesity drugs that we spoke about last time that seem like they're a game changer in terms of treating obesity. And then sort of driverless cars. All these things are pointing to excess deaths actually falling below. But we've got the opposite at the moment, and we think there's there's an investment theme for you at least to think about and be aware within whatever you're dealing with in terms of portfolios.
And it's worth highlighting that one of the inflationary drivers over the last few months has been significant increases in insurance premiums.
Yes,
right?
Yes, exactly.
And that's partly because of this issue in the health insurance sector. Of course, they are sort of controlled, but not necessarily as strongly. But also, if you look at the other insurance sectors too, there's been a lot of significant pricing increases, and it's one of the inflation drivers.
Yeah, and so and just to I guess reiterate the couple of different versions of that. So the life insurers went from, we think there'll be a catch up at some point, so we don't really need to reprice that much, to, oh God, this thing's lasting for ages, we're pricing it in. And so that's why you've seen a big jump in terms of those. And I just, the company statements over this last reporting season were just stark in terms of, repriced everything, resigned, it's here, it's staying, was effectively the message. The general insurers has a lot of that's been about the cost of construction and the cost of used cars and new cars as well. And so the question for those ones is, are the general insurers going to pick up a bit of a windfall gain as well in terms of if car prices, we're starting to see price wars in China in particular, but also starting to spread elsewhere. If car prices do come off the other side and we get the benefit, then they've all priced up their all their premiums for saying car prices are going to be higher, and so we need to charge more premiums. I doubt they'll give it back. They'll probably just take bigger profits when for a couple of years until that gets compared to the way.
Absolutely. It'll be very interesting to see. Well, let's move the conversation on to another one. And of course, gold is worth talking about briefly, right? Because the fact is that we've actually had now another tilt at more than 2,000 US. This is on the gold futures, of course. It's sort of hit that a few times in 2020, 22, 23. It's come back a little again. So there's an interesting question about what's going on in the gold sector. Is this? I was looking at somebody the other day who was claiming that this is the breakout. This is somebody who's been saying there's going to be a breakout in gold since at least 2005, 2006. What's your take on this? Is this a significant move, or do you think it's just a bit of noise and it'll come back down again?
Look, I think the main thing for gold, let me talk about where I see gold as, and that's obviously a big sigh when I'm talking about gold. The issue I have with gold as a more general sense is, it doesn't actually earn anything, doesn't do anything. It's a greater full investment in many ways. And what I mean by that is you're buying it because you think I'll be able to sell it to somebody for a higher price. And the biggest users of gold is central banks and investors. And so effectively what I'm trying to do is second guess what other investors are going to think and second guess what central banks are going to do. And that's sort of because the actual commercial uses of gold are so small relative to even jewelry is relatively small, relative to investors and central banks. So there's a question about real interest rates and when you want to own gold and any of that. And I guess that argument flows through to Bitcoin, as you said, you spoke about. I think they're both rallying on a similar a similar hope is that inflation is defeated and I think you can. I won't go through the whole gold. There's lots of gold bulls out there that'll run the arguments. I do have some gold in the portfolio at the moment. We've had some for a little bit with a view that look, it does provide some hedging benefits, and I do think there's a in certain macro environments, you can see why people will want to own gold. And so, incorporate that. Having said that, it's a relatively small holding within it. Within the passive portfolios that we've got, we do have 3 different flavors. So if you want gold tilts, you can either have a gold stocks tilt, you can have a gold tilt to the physical underlying gold, and you can have a hedged version as well to get, if you want to tilt your portfolio towards gold. I don't know. What do you want me to say, Martin? I'm not trying to.
No.
I'm spinning a little bit here.
No. I mean, it's interesting. As somebody was saying, we'll bring Peter Schiff on. I had Peter Schiff on 2 or 3 times. If you go back and search the YouTube channel here, and Peter was always arguing the same, that gold is the cornerstone value anchor. It'll eventually come good. It's worth at least 5,000 US, etc. Right? It's just that it hasn't happened yet. And it's interesting because it goes back to you mentioned a bit of religion earlier on, right? I think there's a religion here as well, whether it's gold or whether it's Bitcoin, and it is worth reflecting that Bitcoin's now at what, 41,000, right? Having been down at 16,000. But there's some fundamental questions that I've got about trying to make sense of those in the context of the broader markets. We know in the gold context, of course, that as you say, some of those big players are big holders, not only of the fundamental gold, but also the future contracts on gold. And so to an extent, it's actually about what's happening in the future contracts rather than gold itself. And it's about trading and all those things. And there's an argument to suggest that's one of the reasons why gold hits the ceiling and then comes back again. But it isn't interesting, and it goes back to your point. When you're thinking about a portfolio, right, and this is where I wanted to get the conversation to for the last few minutes. When you're thinking about building a portfolio for the long term, what are the parameters that you need to sort of think about? I guess there's a risk dimension. There's also a growth dimension, but there's also a what if I'm wrong direction.
Exactly, and a diversification. So, I've looked at portfolios. I just had this distinct memory of this person coming in and saying, "Oh, yeah, I've got a pretty diversified portfolio." And you're like, "Okay, what have you got?" "Oh, I've got some property here, and I've got own the Aussie banks, and I've got some property trusts, and I own this corporate debt fund that when you actually dug into it was actually 60 or 70% Aussie banks as well." And then there was something else as well. And you end up going like, you've just got 7 different flavors. Yeah, you think you've got all these different assets, but you've got 7 different flavors of exposure to the Australian property market. And so there is that part about, have I got things that are going to go up and down at the same time? And, your classic sort of argument for this is saying, okay, I'm selling stuff at the beach. I want to sell umbrellas and ice creams because on the days when it's rainy, I'll be selling umbrellas, and the days when it's sunny, I'll be selling ice creams. With the idea that, I've got these 2 assets that go up in this sort of, some sort of wave as they go, and I want them to be offset so that as one's falling, the other one's rising, and then I can get this nice sort of smooth line on the way up. Is your idea? Is your perfect diversification? Now the reality is, you can't get perfect diversification, and that assets, even more so than before, are are increasingly correlated to each other, and but there are some you still can get some reasonable diversification within what you've got, and trying to work out where the different countries' exposures, what are the different sectors' exposures, and gold in particular is often a sector that will move contrary to other sectors. That was sort of one of the big arguments for when I first came into broking in sort of the early 90s was that gold had a negative correlation to other assets, and so you could afford to buy you put it in your in some of your models, and you could afford to pay a 30% premium for what you thought the gold thing was worth, because it had a negative correlation to your other assets. And so I definitely don't buy that argument, but I certainly buy the argument that there's certain assets you hold because I might be wrong.
Yeah, and it's interesting, just one observation. If you think about our major banks, they are 65 to 7% leveraged into property. So in a way, the banks in Australia are predominantly property-related investments, which a lot of people don't actually think about. So you've actually got your property, and then you're holding bank stocks, and suddenly you're overweight.
Bank hybrids.
Exactly.
There's bank hybrids as well. Yeah.
Exactly. So thinking about diversification is actually really important. And I think also geographic diversification is also just worth underscoring, right? Because there are things going on in the Australian context which are unique to Australia. There are some other dynamics in other markets. And sometimes the right answer is to make sure you've got some exposure beyond the Australian context.
And in a way, I'll say to people, what you're trying to do with your investments is to sort of fund your retirement, or fund your lifestyle, and your lifestyle contains a lot of foreign spending. So if you're planning on buying a car sometime in the next 20 years, chances are it's not going to be made in Australia. There's a very strong chance it's not going to be made in Australia. And so you want to hold some international assets because a certain part of your spending is going to be reliant upon, you don't want the Aussie dollar to plunge, and all of a sudden I can't afford to buy the car I want, or things like that. And then you go through all the other things that are brought into Australia, and the services we use, and I'm buying my Netflix, and I want to buy an Apple phone or a Samsung or whatever it is, and all these things that you want that are international assets. And so if you only stick with your portfolio in Australia, you'll find you run the risk that the Aussie dollar moves in the wrong direction, and you're left not being able to afford to buy all the things you want, or even just having overseas holidays and things like that.
Absolutely. And sometimes it's a little easy to sort of just think local, but I actually think when you're investing, you need to think beyond local because of the reasons you've just said. And just bear in mind, of course, that the Australian market is 1% of the global market or something. I mean, it's a very small proportion. Yeah. And it's, as you said earlier on, highly leveraged into certain sectors. So, the mining sector and property and those sorts of things. And we're talking about the Magnificent Seven, and so cloud computing and a few others that have just been booming. There's just very little exposure in the Australian market to some of these themes, or the obesity drugs that we're talking about. That's there's only two companies that are really in any way doing that, and so one's in Denmark, the other one's in the US. And so if you're stuck in Australia, or even if you're just sort of picking just the US, you're missing or something like that, you can really miss out on some of these themes. Yeah, interesting. Now, last thought before we tidy up. Some of the questions earlier on related to AI and whether, in fact, AI is now able to make the stock picking and stock investment decisions. So, in other words, can you just chuck your investment strategies to an AI and let it do its thing? Yeah. What do you think?
You absolutely can. Will you make money out of it? That's the key question. Yeah. I would. I've been doing a fair bit of work with some of these generative AI things. Actually, no. Let me take one big step back. AI in investing has been around for a while. Like it's not like we've got these great new tools that are very good at understanding human language and are very good at interpreting what I really want and bring back. The actual tools they use are very similar to tools that have been available for a while now. And so AI has certainly been tested pretty thoroughly in most quantitative firms. There's now lots. You've now opened it up so that lots more people with less technical knowledge can do the analysis. What I tend to find, and it's always been the case with the AI models over stock markets, is they overfit. Like you end up basically saying, "Oh, look, here's the 23 stocks you should have owned, which would have been this great diversified return or whatever over this time period." But as soon as you step outside that time period, it all goes to crap. So some of the bigger themes, I spoke about before about momentum as being one of the key ones, and quality stocks or growth stocks. And some of these factors you can see over time how you get those factors, and it's a relatively dumb trend. You try and be a little bit clever about how you do it, and a little bit throw out some of the false positives and avoid some of the false negatives and things like that. But it's something that sort of sits as a relatively, you can do it in sample and out of sample, and so what I mean by that for anyone non-statistical analysis is I can look at like a 20-year period from and build my model from 1980 to the year 2000, and then I can run that for the next 20 years, and I can get results that are in some way reasonable. Whereas the AI models tend to give you this fantastic result over that 1980 to 2000 model that I just built, and then once I let it loose on post 2000, just goes to crap, or I pick it on whatever period you pick, and so that's where the danger is. The other thing is, look, I do think this AI, I think there's a revolution coming with it. I do think there's going to be these great productivity gains. I've got all these positives I want to say about it, but the practical side of actually using it, for anyone who's using it to actually come up with some real solid numbers. So we've been using it as an example to pull data out of research reports where what'll happen is you get, so a company has an announcement, there'll be several hundred pages of an annual report, plus there'll be slides they're giving to investors and all these other things like that. And often some of the data we want is hidden. Like there's one that's on page 300 in this document, and then you have to go and look at some slide presentation where they gave you an intimation about something else, and then you have to go and look at a transcript where they mentioned another number and pull them all together and go, okay, actually now I know what that is, and pull it out. And so we've got a sort of fixed base, and the generative AI can come up with the right answer sometimes, and then exactly the same requests give completely the wrong answer, or they make up something that's just completely wrong, and you're like, where did you get this from? It's not even. I'm trying to isolate you to just this data. I just can't work out how you even came up with the number you came up with. And so I guess what I'm saying is they're very good for marketing sides and things like they don't need to be exact, and they're very good for the text side about I need you to create some give me a form letter for whatever it is you're trying to do. That's there's great productivity gains, and there's stuff it's already ready to do and just needs a bit of tweaking. About coming up with exact answers and coming up to the right answers, it's pretty poor at, or at least inconsistently good at. I mean, which is probably not that different to poor, but it's and that's what I guess that's the big issue is that I completely believe that there are people out there who point their models at this and get some fantastic results for a period of time, and then they could just as easily blow the whole thing up. So yeah, I'd be very circumspect.
Yeah. Well, I've been training AI on my own data, right, over the last 2 or 3 months, trying to see whether it actually comes up with as good analysis as mine, or better or worse. And I have to tell you that so far, the results have not been that flash. It sort of takes the obvious stuff, but it doesn't necessarily take you into a new set of connections or a new set of insights. It sort of just rechurns what you already knew. And I suspect, I don't know whether that's always true in an AI context, but it seems to me quite often that it almost is defined by its own inputs.
Yeah, well, and I think, and I guess the other thing to say is look where what are we, 9 months, or maybe we're 12 months into this now, 12 months really into the release. There's going to be lots of changes. And that's part of what we're doing is we're as we're building this is literally saying, okay, this isn't doing what we want it to do. We think we've actually defined things the way we want, but let's make sure as we're building it now so that when, okay, this failed, but when ChatGPT 5 comes out, I can point that at the same thing and see if it gives me a better answer or whatever it is. And so, yeah, I think there's lots of areas where it's going to be helpful, and certainly trying to understand what people are saying and give answers about, we're trying to use it as well to answer customer questions a bit faster in terms of, somebody asks something and you say, oh, that actually looks like you're asking this question and here's the answer. Is that correct or not? That type of thing, I think will certainly save lots of, be very productive and save lots of people. And the whole idea of, write me this or check my program, see if you can find any errors in it. I think it's very good at doing that. See if there's any security flaws and things like that. It's very helpful with. But yeah, here is a set of inputs that should add up to a known answer. I think it's it's not ready for the showtime yet on that front, and I think investing to me sort of fits into that category.
Absolutely, and just to acknowledge Jason's comment, Jason, thanks for the super chat. That there's lots of scams around connecting AI, crypto, and all of those things, and people are being scammed quite readily. So it's just worth taking note of all of that.
Yeah, well, actually, there's two parts of that. Two things I wanted to talk as well. One is the I don't know if you've heard the voice ones, 11 Labs.
Yes.
You stick your voice in there and it sounds exactly like you. And I've got no doubt that there will be phone calls from panicked kids to their parents explaining whatever problem they've got into, and you just need to send money to some account you've never heard of, and whatever it is, and it will sound like your child, and you'll be able to have a conversation with them, and yeah, but it will be a voice-driven scammer on the other end trying to feed that through. So that was one thing. The other thing I wanted to highlight as well is on this whole quantitative. How do you make money from using quantitative programs? I just want to, in the back of people's mind, if you are ever doing any of this, I just want you to think as well about there's a real question about why you're getting paid. And insurance is a great example, is that Nassim Taleb does a lot of good stuff on this about people feel really good about making lots of small amounts of money, and you can do it consistently. And there's a lot of strategies out there where you're effectively selling insurance to the market. And what do I mean by that? So if I want to start selling home insurance to my friends and relatives and all that sort of stuff like that, I'm charging $100 a month, and the first month comes in and I've got 10 of my friends, and it's like, oh, there's $1,000 coming in. Look at that. And then the next month there's another $1,000 and then another $1,000. Hey, how easy is this? I just sit here and collect money. And all of a sudden somebody's house burns down and I've got to spend $700,000. And I'm like, I collected $24,000 over the course of 2 years, but it felt really good while I was doing it because I was just making money every month. Every month I'm making money. And then all of a sudden, boom, it's all gone and plus more. And that's effectively, there are some strategies out there, some investment strategies where you are effectively selling insurance to the rest of the market. They're basically saying, we want you to own these securities all the time because we don't want to own them all the time because there's so much risk in it. And we're going to pay you a little bit of money every single day in order to hold these securities. And then once every 3 or 4 years, you're going to lose 10 times what we paid you. And so some of the quantitative strategies that people set up are effectively just doing that. It's a harvesting of those ones. And so, yeah, it'll feel great. You'll make all this great money until one day when you don't. And so, I just want to, with any strategy you're doing, I always want to come back to, well, why am I actually being paid this amount? Do I think there's a genuine mispricing, or is this actually just a risk that nobody else wants to take? And I'm the sucker at the poker table who's turned up wondering why everyone's losing to me at the start until I start placing some big bets, and all of a sudden I get cleaned out.
Yeah, absolutely. And just remind you that you can get 5% plus in a term deposit, right? Just remember, folks.
Yes,
in the current environment. Damien,
Yeah.
last question from Cookie Boy. So are we in a classic bull trap, or will markets be reaching a higher high? So what do you think?
Yeah, I do think it's a bull trap. Uh, yeah, I do. But could it run for another couple of months before it goes? Yep, I could see that as well. And the other problem is the problem I see at the moment is the downgrades. The earnings downgrades are happening, but they haven't been happening all at once. They're sort of just leaking out, and so it basically just seems as if there's this wild optimism for the last 9 months in terms of what's going to happen next year. And then it just gets pushed out a little bit. Oh, it's okay. It's going to be a month after I thought, and then the next month and the next month. And so the danger is the danger is that you get a sudden rush of downgrades, and then that all turns pretty quickly,
Yep.
Which could happen. And I think the issue continues to be, look, we've priced in a pretty perfect market, and if we don't get perfect, then there's trouble.
Absolutely. Well, I've said for some time, I think volatility will continue. I think that the journey over the next 12 to 18 months is going to be much more wobbly than the markets are pricing in. And therefore, you need to think about what if I'm wrong, as well as, hey, this looks like a good opportunity, which is what I've always tried to say. If I'm wrong, what happens?
Exactly. And the other thing I'd say is actually over the next, I'd even say it's the next 5 years.
Yeah.
If we're looking at inflationary bursts and then back to deflation and inflationary bursts and back to deflation, is that it's the type of market where it's going to be a relatively what I call a trending market, it's so when the market pulled back 10%, we picked up a little bit more stocks. And then we're still underweight, but we picked up a bit more, and then markets have risen up, and we're starting to tip a little bit out. And the idea is that what you want to sort of have these rough parameters, whatever yours are, in terms of saying, okay, these are the levels where I want to start buying. And it's not okay, I'm going to wait until the absolute perfect second, and then I'm going to press button, and I'm going to go from zero, in the market to 100% in the market, and then it's going to rise, and then I'm going to suddenly tip everything out. It's about saying, no, look, you're never going to get everything exactly right. So, I want to own 80% equities and 20% bonds. Maybe you'll let it, when the markets run up, you let it drift down to 60%. And then when they pull back, okay, now I'll lift it a little bit to 70%. And then they fall back again. And, now I'm back to 60%. And then you do get the downturn, and they're like, okay, now I'll go to 80 or 90% because I'm actually buying it at a reasonable price. But it's about sort of the discipline of actually picking some levels and just sort of trading in and trading out, because I do think it's going to be this sort of trending market where we get some sharp rises in equities, and then some sharp falls as well.
Absolutely right. Well, it'll be an interesting time, and we're coming back at the end of the year for a bit of a end of year review and a thought about what's going to happen next year. So that's going to be the first. I think it's the first in January, as I recall.
Yes.
Yeah.
Look forward to it.
Look forward to that. And always great to get your insights. Thank you very much, Damien, for your time tonight. So many interesting things to explore, and we'll always come back for another dose next month. So look forward to it. Thank you very much.
Thanks a lot.
See ya. There you go. Right. So that's another show over. Thank you very much for all the questions, comments, and interesting chat. Couldn't get them all up, but hopefully covered a few things. Just to say that next week, I'm going to be talking about the latest financial stress and modeling that I've done. Things are looking continually difficult. So that's worth coming and listening to. And of course, over the next few days, we'll be putting up more recorded shows. There's a few things going on in the background, so watch for those. Hope to have a conversation with Tarek on Friday as well. And just before we go, you can see one of the two dogs. Luna is now fast asleep. Meteor is down here under my feet, so she's not in her bed. Anyway, thank you very much for spending some time with us tonight. Thanks for all the questions, super chats, and everything else. And we'll look forward to seeing you on the next show. This is Martin North from Digital Finance Analytics, signing off. Cheerio.